So today I want to share with you an intriguing scalping trading strategy. This strategy leverages a simple yet powerful phenomenon that a market's open price sometimes matches its highest or lowest point for the day. When this occurs, it creates a scalping opportunity. You see, on such a day, the market has essentially revealed where it sees strong support or resistance. Picture this. The open price matches the initial low. This tells us buyers stepped in early and established a clear support, showing where they'll defend the price going forward. Similarly, an open equal to the high indicates sellers wasted no time capping further upwards moves, laying out a firm resistance. These congruent levels provide prime entries if you trade accordingly. Think about it. When the open equals the low, indicated on most platforms by a green candle, it tells us buyers were able to push the price up substantially right from the open. This demonstrates eager demand exists among buyers at those levels. Upside momentum is likely to continue, presenting a high probability buy entry. Conversely, if the open matches the high, denoted by a red candle, it reveals sellers could immediately press the price down from the highs. This shows willingness to sell around those areas. Downside momentum typically follows, offering a short setup. When analyzing the markets, it's important to have the proper tools to easily identify these signals. Unfortunately, TradingView does not have a built-in indicator to directly find the signals of the open matching the low or high. The best solution I found is to use two simple indicators together. First one is the open price. This displays a horizontal line marking the open level right on the chart. It allows a quick visual check to see if open matches the high or low. The second indicator is the opening range breakout. This draws upper and lower lines connecting the highs and lows of the first 5 minutes of each candle. So make sure to set it to the 5-minute time frame you want to trade. The two-indicator approach is the cleanest workaround for easily finding signals if you monitor multiple markets. With this, we can visually compare the open price to the opening range high and low lines. When the open price line tags the low line, we have a potential buy signal. If it touches the high line, it's an opportunity to sell. It's a bit manual, but that's the closest solution within TradingView's library. The opening minutes each day will provide powerful clues about potential scalping opportunities, but also an overall directional bias. The key point is that when the open matches the high or low, it suggests there is strong momentum. This often leads to increased volatility, and this presents an opportunity for us, scalpers, to jump in and capitalize on future swings. The plan is simple: to catch quick moves based on the early momentum. A match between the open price and its highest or lowest price confirms the likelihood of an established directional bias for the whole session. If the open price drove strongly up from lows, it raises the probability of an extended bounce play for trend followers. Vice versa for an open matching the high, signaling brief downside potential. The main advantage of this scalping strategy is definitely its simplicity. There's no complex indicators or customized formulas to configure, just basic pattern recognition of the open in relation to the initial high and low. These signals require little time investment to analyze and execute on. You can simply monitor the 5-minute chart for a few moments at open and immediately identify an opportunity. And with potential trades taking shape in minutes, everything must be streamlined and optimized. Usually, a buy or a sell signal is generated within the first 5 or 15 minutes of the trading day. You can play around with the time settings and see which one works best for you. As volume increases during the first 5 minutes, it naturally causes prices to oscillate more widely. This volatility stretching the highs and lows creates prime openings for strategic plays. In this chart, the open price is matching the day's low, And this reveals that smart institutional players have stepped in overnight or pre-market to dominate the session. The sellers didn't have any power to move price, not even one tick below the open. This is very bullish in my opinion. When the open builds on this support, slowly but steadily through buying pressure, it frequently initiates an extended trend up as demand proves stronger than selling. In this example, the open matches the high, suggesting selling pressure dominated early, with supply outweighing demand right from the market open. Often this indicates institutional or other professional traders were taking profits or establishing new short positions pre-market. Seeing this action telegraphed so clearly in the opening minutes is extremely valuable for day traders and scalpers looking to ride the overall trend. It informs you that big players expect short-term downward momentum, at least initially. There are two types of entries. The first one, entering long on the first push above the first 5-minute candle or immediately after the candle has formed. Quality liquidity lies below, and the initial bounce often has follow-through as momentum traders join to ride the wave up. The second entry, at the 50% Fibonacci retracement of the initial candle, if the candle is larger in size. You see, sometimes it's better to wait for a retracement and then enter in the direction of the initial candle. The aggressive entry comes after you monitor that first critical 5-minute candle. By waiting the first candle to form, you allow the initial dust to settle while key levels establish. For an open equal to the high, I'd set a sell order a tick below the 5-minute candle's low. Smart money likely capped upside there, and a break suggests distribution might persist. Conversely, an open matching the day's low presents buy triggers on a push above the 5-minute high. The low confirms underlying support, and a break above could signal buyers maintain control, pushing prices up further. As you are scalping, always risk small with tight stops above or below the 5-minute range. And a quick tip, volume-backed breakouts often spark quick continuation as momentum traders pile on. I kind of prefer the more conservative entry. Rather than entering signals immediately at the open of the next candle, I wait for a retracement back to the midpoint of the opening 5-minute candle before triggering my entry. So we enter in the direction of the expected momentum move at a better price after some pullback. This improves our risk to reward ratio, and we avoid potentially getting stopped out on wider, more volatile opening candles if price whipsaws before the impulse begins. Essentially, we are refining our execution using the opening candle range as a guide. Rather than rushing in at the initial 5-minute candle breakout, waiting for a modest retracement often helps manage risk better. So remember this, overextended openings frequently pull back within the range. In this case, tightened entries on a pullback to the midpoint provides a lower risk second chance if momentum stalls, without missing the trade entirely if it resumes swiftly. As for stop placement, keeping them near the open price often offers the best compromise. It preserves your capital should the setup fail, without getting stopped prematurely from temporary fluctuations. An alternative is, as swings develop, raise stops proactively to lock profits and capitalize on extended moves, but avoid trail stops that can whip you out of positions too hastily. One of the most precise ways I've found to extract maximum gains from this scalping strategy is by factoring in anchored VWAP bands around that first influential 5-minute open candle. You add the upper and lower bands anchored to the opening price to highlight potential areas of support and resistance around the main VWAP line as the day progresses. Now, when you enter a scalping trade, you initially target the second or third VWAP band in the direction of your entry for partial profits. For example, if you go long, you target the upper anchored VWAP bands for the first take profit. If you go short, you aim for the lower VWAP bands for initial gains. As price reaches the bands, scale out a portion of the position while trailing a stop on the remainder to lock in further profits if momentum continues beyond VWAP. The key benefit of using the anchored VWAP bands is they objectively highlight profit areas based on that day's developing value area. Using multiple exits using VWAP bands makes your trading far more dynamic and adaptive. Aiming blindly for fixed risk to reward ratio on every trade can be limiting because price movements and volatility fluctuate. Some momentum surges will exhaust quickly after your entry signal. Others may continue trending strongly beyond your static target. This is where adding adaptive exits like VWAP bands becomes highly useful. If momentum fizzles out early, the VWAP bands can alert you to take profits nearer to your entry. If the momentum explodes with thrust, the bands help you trail stops to capture outsized gains. Either way, you are basing exits on the real-time developing market context, rather than just assuming a preset target will be hit. Remember, you are scalping, so managing risk smartly is the foundation to your long-term success. Consider reducing position size if entering on wider opening candles, and trail stops incrementally to lock in profits as the momentum wave extends. Learn to scale out partial profits in pieces rather than exiting the whole trade at once. And if you want to discover other scalping strategies, you might want to watch one of these videos.